Today we're going to be talking about how you can invest to outperform over 91% of actively managed funds on Wall Street. This is something that anyone can invest in and achieve amazing returns over time. What I'm describing are index funds. Now, you've probably heard of these and also mutual funds, and if you're confused on what they are, then you're not alone. So in this video, I'm going to explain what they are and give you the reasons why you should invest in index funds. If you're new here, my name is Edgar, and on this channel we talk about personal finance, investing, and business. So if that is something you want to learn about, consider subscribing. First, let's start by talking about what index funds are. An index fund is an investing tool that is used to match the returns of a certain market and is a way of indirectly buying the whole market. One of the most popular right now is the S&P 500, which is a basket of the 500 largest companies listed on the stock exchange. For example, let's say I own 100 single-family houses and you want to invest in real estate. Well, you have two options, and that is you can buy one of the houses I own and you become a 100% owner of that one house, or you can invest with me and we combine our money and in return you own 1% of the 100 houses. This is the same if you wanted to invest in the stock market, because your two options are buying one share of a company and you own 100% of that one share, or you combine your money with many other investors like yourself and everyone owns a percentage of a big basket of stocks. The problem with owning 100% of something is that you carry all the risk, and if that one company goes out of business, then you risk your entire investment. A good example is Enron, which was a company that used accounting loopholes and bad financial reporting to hide billions of dollars in debt from failed deals and projects, causing it to go bankrupt. At one point, the stock was over $90 a share, and after the scandal came out, the shares dropped to below $1. So if you own 100% of Enron stock, then you would have lost your entire investment. But if your money was invested with an index fund, then you probably would have never even noticed a difference, because that one stock was such a small part of your entire basket of stocks. Yes, you could go and buy one share of many companies and try to create your own diversification, but that's inefficient and will probably cost you more. So why do that when you can invest in the Vanguard 500 index fund? There are several advantages to index fund investing, so let's cover the top ones. The first advantage is they are very safe investments and they'll basically never become worthless. The reason why they are safe is that you are diversified, so if one stock drops in value, you have many others that will counter that one stock, and if a company goes bankrupt, then it gets removed from the basket and replaced with another stock. Also, because the fund is diversified across many industries, you are not exposed to the effects of one industry. Let's say there's something going on that makes all these stocks in the oil industry decrease. Well, the index fund has stocks that are in retail, consumer goods, and utilities, so that will provide you with protection. Also, many people cannot control their emotions. When they see a stock going down, they panic and sell. Then when they see it going up again, they buy back in because they don't want to miss out. The point is, many people cannot control their emotions when it comes to investing, so they make choices that gets them a lower return than a fund would. As I mentioned earlier, the S&P 500 index fund is a basket of the 500 biggest companies in America, which is why it will never become worthless. So for that index to become worthless, then every single one of the biggest 500 companies will need to be out of business, and that will never happen, and if for whatever reason it does, then you probably have bigger problems to worry about. Investing in the 500 biggest companies is like investing in America, which is why it is a safe investment. The second benefit is that investing in index funds requires little work. When you're looking to invest in stocks, you must do lots of research to pick the right stocks. For example, you must read income statements, balance sheets, and cash flow statements along with the quarterly and annual reports, which takes time for one company. So can you imagine the amount of work it will be to do that for every company you are thinking about investing in? And doing research isn't just a one-time thing. You will have to do this often with the stocks you own to make sure the business is still doing good. Then you will have to do research anytime you're considering investing in a new stock, even if you already did research on it in the past. Let's say you were interested in investing in Apple a year ago, but after you did your research, you decided the stock was too expensive, so you passed on it, but now you see that the price is down, so you become interested and think about buying it. Well, even though you did your research on it in the past, it was a year ago, and the business could have changed in that time, so now you will have to do research on it once again. And doing this kind of research is not something you can do in 30 minutes, because it might take you longer than that just to find all the information. Then you still have to go through it, make notes on everything, and then you can make your choice. Also, investing on your own requires constant maintenance of your portfolio, because you want to make sure your allocations haven't changed dramatically and all of a sudden you are invested in one sector more than you will like. For example, let's say you invested $10,000 into 5 different companies. That means you have 20% in each. If one stock drops and another increases, then you could have one stock that's 10% of your portfolio and the other is 30%, which can expose you to risk. So you would have to go in and make the adjustments yourself. By investing in a fund, you eliminate all this because everything is done for you. You basically buy into the fund whenever you can and forget about it until next month when you make another deposit. This way of investing eliminates all the stress that comes with researching and managing your portfolio. This is great because your time can be better spent doing something else like spending time with your family or focusing on your business. The third advantage you get with broad index funds is the low cost. The reason why these funds are so cost effective is because they simply hold the investments, so there isn't a need to pay a fund manager or researching teams to actively research and make trades. Right now, the Vanguard 500 index fund has an expense ratio of 0.04%, which is basically the lowest you will be able to find. The low fee means more money in your pocket, which equals higher returns. Now that you have an idea of what index funds are, let's talk about what mutual funds are and how they are different. Just like index funds, mutual funds are a type of investing tool made up of money from many different people, which then gets invested. The difference is that mutual funds are actively managed and the intention is to beat the market. This is a total opposite of how index funds operate because they only try to copy whatever the market is doing. And because mutual funds are actively managed, they employ many people, which means they have higher expenses, so the fees are higher. Mutual funds need people to do all the research, they need a fund manager, and they need infrastructure, and at the end of the day, you end up paying for it. And because the point of mutual funds is to beat the market, they do more trading than a passive fund, which again means even more fees. Not to mention that during a 10-year period, 85% of actively managed funds underperformed the market, and over a 15-year period, 91% underperformed. Now keep in mind that most portfolio managers are Ivy League grads who have worked on Wall Street and are supposed to be the best in the field with a deep understanding of the stock market and the economy, yet most of them cannot outperform the market. So when you consider the high fees and the chances of underperforming the market, you can see why most people are better off investing with index funds. While a few percentage points in fees might not seem like a big deal, it can add up, and the worst part is that money is no longer working for you and making you more money. The fees for actively managed funds vary, but they typically range between 0.75% and 2%, which is many times more than the 0.04% for the Vanguard 500 index fund. And these fees are charged annually, so it's not like you pay once and you never pay again. Let's say you have $1 million invested in a fund that charges 1%. On your $1 million, a 1% fee is $10,000. Compare that to a 0.04% fee, which is only $400. And because the fees are paid every year, would you rather give up $10,000 or $400 every year for the next 10, 20, or even 30 years? A lower cost means more money working in your portfolio, so when you consider the lost money from underperformance and the high fees, you could end up missing out on hundreds of thousands of dollars over time. Now let's talk about what is known as a 3-fund portfolio, which is one of the most popular index fund investing strategies. A 3-fund portfolio is made up of 3 funds which are invested in US stocks, US bonds, and international stocks. This portfolio invests in the lowest cost index funds, so you get diversification at the cheapest price. The result is you're pretty much guaranteed to get the returns of the overall market without the stress that comes along with picking a stock that goes down in value. Not to mention, you will be getting better returns than most people out there, and all you have to do is sit back and wait. The reason this strategy works so well is that you're adding multiple asset classes to your portfolio. So now you're not just diversified in one market, but you're diversified across 3 markets that are mostly uncorrelated. So if you have something happening in America like people defaulting on their houses and our markets decline, well, that can be offset by Canada discovering huge oil reserves. Then you also have the bond market, which is always working to provide steady income. Vanguard is a great place to buy these funds, and the US stock market fund is called the Vanguard 500 Index Fund. Then you have the Vanguard Total Bond Market Index Fund and the Vanguard Total International Stock Index Fund. And that's how easy it is to be most active traders out there. Now, when you're thinking about how much money you want to invest in each fund, you should consider a few things. First, consider how old you are. Second, think about if you plan on making any withdrawals anytime in the future, or if you're investing for retirement and you won't be making any withdrawals until then. And third is, does the thought of your portfolio dropping by 40% make you panic? These are questions only you can answer, and it will determine how your portfolio looks. But let's go over some of the more common allocations. The first option is the 80-20 allocation, where you're putting a total of 80% into stocks and 20% into bonds. And you can divide the stock allocation between US stocks and international stocks. Let's say you go with 64% US stocks, then 16% for international stocks. This portfolio has a more aggressive allocation because you have 80% invested in stocks. The second option is an even allocation across all 3 funds, which means you invested 33% of your money into each fund. This allocation is less aggressive than the last one because you only have a total of 66% invested in stocks. The third option is the 20-80 allocation, where you're only putting 20% into stocks and then 80% in bonds. You can divide the stock allocation by investing 14% in US stocks and then 6% in international stocks. This would be an example of a conservative portfolio because most of your money is in bonds. The first portfolio would be great for someone who is far away from retirement and is okay with taking on more risk in exchange for higher returns. Since the person who picks this portfolio is most likely younger, they have much more time to recover from a short market drop. However, this allocation wouldn't be ideal for someone who is a year out from retirement because if the market drops during that year, then a big part of their retirement account is gone. The second portfolio is for someone halfway to retirement or someone who is still far away from retirement but doesn't want to take on much risk, since this allocation puts 33% in bonds, which normally have less risk than stocks. And the third portfolio is for someone who is close to retirement, which is why 80% of the money is invested in bonds. Even if you're very conservative with investing, I wouldn't suggest a young person invest 80% of their money with bonds because you will miss out on great returns from stocks. The first advantage of the 3-fund portfolio is the diversification you get. One index fund alone provides you with great diversification, but investing in 3 different index funds will provide you with more diversification than you can get anywhere else. The 3-fund allocation tracks over 11,000 stocks, so you will have exposure to the biggest companies in the US all the way to companies in China. The second advantage is the low cost because the funds you will need to create this portfolio are the least expensive to own, and paying anything more than you need to in fees can end up costing you hundreds of thousands of dollars over time. And the third advantage is how simple and easy it is to invest this way. This method doesn't require hours of research and it's easy to understand. All you have to do is make a deposit every so often and you can sit back and watch your money grow. Either way, you should really reflect on yourself and find out what works best for you and how you can get the best results. Even if the majority of your money gets invested into real estate or your business, you should still invest in the stock market in one way or another. Because not only do you get diversification, but for a small amount of money, you can get a piece of the action and you have all the benefits of that company growing over the years. And while you focus on your career or business, that money is there working for you morning, noon, and night. So with that being said, you should have a great foundation to begin investing. So now it's up to you to open an account, transfer money into that account, and let that money make you more money. If you enjoyed watching or you found this information helpful, it would really help if you like and subscribe. Thanks for watching, and I will see you next time.